according to you, are the sectors that you think will be back in vogue? Of course, I've read your wealth creation study, and there we've spoken extensively about financials. But which are the sectors you think will come back in vogue in this year?
So right now, things are slowing down. See, one of the things is that market is fully priced. At 22, 23 PE, we, on the multiple side, we are very well up there.
Right.
Okay, now the earnings must do the magic.
Right.
And earnings were supposed to be pretty strong for the, kind of 23, 24. So that's also getting cut, so the now earnings growth of 23, 24, they're talking about only 10%. So I would not hazard a guess that, the moment earnings take a turn, markets will also take a turn. If the assessment goes up that earnings are going to come at 15%, 17%, obviously markets will fly. But if the earnings are going to remain at 10 or below 10, then I think market might remain plus minus here.
When you say
very range bound, in the sense that, say if it is 18,000, it might move between 16 and 19 and a half types.
Sure, that's exactly what I was actually going to ask you. I was going to ask you about your corporate earning growth projections. And also, I think the consensus is with the Fed rate hikes now being a little slower in this year, right?
These are gods, and there are so many things moving. I hope inflation gets killed and hence the Fed tightening slows down. But I think to achieve their objective of 2% inflation on a sustained basis, I think we are quite far behind from that. So I think the entire 23 at least will go in figuring that out. But markets are smart. If they see that things are achieved, then way ahead of time they'll start moving. So a lot of this kind of whipsaw kind of a trade can happen, where global equity can again come into vogue. But if you ask me, it looks very unlikely for the year 23.
Sure. So any specific themes that you'd like to focus in for this financial year?
No, then it comes to specific stocks and maybe some segments, where you get, say, tech. Tech is my favorite. I like them. So in the tech, can we get 25-30% growing companies? So right now it is out of favor. So multiple will also be reasonable.
Right.
So can I get some tech companies at those kind of valuations? Or for that matter, one of the things this wealth creation study also is about consistence and volatiles.
Right.
So we have to focus a lot more on consistence.
Right.
So when we focus more on the consistence, the valuation takes a backseat. Not fully, but to a large extent takes a backseat because the company will keep becoming bigger and bigger year after year. So it doesn't matter you paid 17, you should have paid 12 or 13, you paid 17. Okay, 1 year you will not make money, but after that through the journey of the company, you'll make money. In volatiles, what happens is that if you end up paying high, then it can crash by 80-90%.
Right.
And you are stuck with that. And then the purchase price being very high, you finally want to sell at those low prices. So, so my focus will be to increase a share of consistence in my portfolio, one by one.
Sure.
So, and only 15-17% of the companies are consistent. The rest all 80-85% of the companies are volatiles. So right now I'm looking at that aspect of it. But making a sector call is actually very tough right now.
I agree.
Yeah, it's very tough.
So when you speak about IT, would you be more bullish on something like a mid-cap IT space?
No, it is of course, mid will be. See, now if you look at IT large caps, they're seriously large. Now you're talking about $22-23 billion of turnover for almost 1.5-2 lakh crores turnover of TCS. Infosys will be closer to a lakh crore turnover. So it was seriously large. Now at that level, to gain a good growth is very tough. Like 10, 12, 30%. But if you're little mid, you are not too small. You're not irrelevant. You are relevant. You can compete with TCS, Infosys, and yet you are not very big. So those companies, truly mid-sized, are very well positioned.
Right.
Yeah. So that's where I think you can get 15-20% growth, and little bit of re-rating can give you at least 20% kind of a return. So finding returns is going to be tough in tech also, but then you can get some small boutique, niches where you can get maybe even 30% growth. And since the industry is out of favor, you might end up buying them at 15, 17, 18 times P multiple. So, there are opportunities. It's a large industry. There are opportunities, and right now industry is out of favor.
That's true.
Yeah.
So if you talk about, we've spoken extensively about IT. So I'm just going to categorize that as defensives versus the cyclicals. Where do you think, where would the traction be more for this year? And in terms of even the valuations, would seem to be a little more cheaper.
Of course, the cyclicals are cheaper right now, and consistent or whatever I would say, stable companies are more expensive. But I think the differentiating thing will be where the growth is going to come.
Right.
So in a stable company, if you can get good growth, then you are going to have winner. But in a slightly slowing down kind of economy, your growth predictions also go wrong very badly.
Right.
Company will give guidance of X, they'll achieve X minus 5. So then markets start getting disappointed. The growth might be good. You grow at 40%, but you are not growing at 60%.
Right.
So those disappointments will come in with a lot of successful companies.
Right.
So one has to be watchful of the fact that what is the growth built into the price of particular company. You have to be very careful, and you know better than market in terms of what would be the growth, and that delta will be alpha for you.
That's interesting, I would say. I would want to ask you about your view on the valuations of Indian equity markets. It's almost expensive, right? On the face of it, if you compare to that with the emerging
by historical
markets,
standards, it is expensive.
Like 70% of the historical means is compared to 40% of the emerging market. We are talking about some numbers out there. You think any of the correction will now enter in, or you think they're going to continue to demand that?
This is where the structural change is happening in India. The retail money is pouring in continuously since 2020. So this is 2021, 22, 3 years. Incessant money is coming.
Yes.
SIP money or whatever you call it.
The
10,
flows.
15, 16,000 crores. And that in a very kind of a 1 year was very good, but after that market has been not so great. And despite that, this thing SIP money is coming in. So if that structural thing remains constant, so then you'll have enough buyers at the whenever market corrects. And if you take the market too high, it's already at 60-70% premium to the emerging markets, FIs will come and sell.
Right.
And we also see if you make the prices too irrational, even the promoters come and sell.
That's true.
Which is very big lot.
Right.
40 to 50% of the holdings are by promoters, and 20% is by mutual fund, international FIs, and 16-70% is the domestic mutual fund, another 15% is the retail. So in that pie, the big player is of course FI, but the biggest player is the promoter. So what will promoter do? If they take the price from 30 to 40p, 50p, will he say, okay, here is my 5% of the company at this price to you? If that happens, and it will happen, some companies will definitely offer enough stock at certain price. And that price point is now, in the sense that beyond this, if you try to pull the valuation, my sense is you'll get a lot of selling.
Mr. Agrawal, also this FII selling, right? We've seen some amount of traction building in the last 6 months, of course, but we also saw a period where there was a huge sell-off coming in, because, and that was not just India specific, I think it was emerging market specific, and India was also a part of that basket. How do you see these FIIs in the larger scheme of events? Because DIIs have been consistent for the markets in the last 6-7 years, if I may so say.
I don't know, it's a very tough call in the sense that FIs, they are underallocated on India. Overall in the global portfolios, they are underallocated. India is growing the progress in the global market cap. We are at about 3.5, because we are not corrected, the world has corrected by 20%.
That's right.
So our allocation has gone up. Like this, if 3-4 years it happens like this, we could be at 5% allocation. But their allocation, since they are net selling, is coming down. So I don't know how will be there. My sense is that at some point of time, somebody is going to ask them, why are you not doing well in emerging market? They will have to say that, sir, we are short on India. So please make it up, that kind of thing. So at some point of time, buying from FIs will come with vengeance. But at that point of time, domestics is buying, foreigners are buying, the markets can again climb up. So I don't see that scenario happening in a very near future, because generally the attraction for the emerging market is not that high right now, in general.
So when do you see India to be at the top position again? Where is the conviction? When is the bull going to be completely out for the markets out there?
You're saying when will...
We've seen outperformance clearly for 7 consecutive years.
Huge outperformance last
Huge
year, like
outperformance.
20%, 25%.
You think now is a point where we'll pause, slow down a little bit and probably consolidate before we go all out?
Who knows? It's very tough to figure out. I'm telling you, it is very tough to figure out. That means, actually I don't know. In the sense that I'm evenly poised. I'm more towards the flat kind of a market, because the flow is so big that, and earnings growth is also positive. So both will get subsumed in the current P multiple. So P multiple, which is at 23, might come down to more like 21.5 after a year, if you stay where you stay in terms of index.
So according to you, corporate earning growth can make or break the market in this calendar year, and obviously 15-16% is what the consensus is projecting.
Yeah.
And you say any number beyond that or below that.
I don't think consensus is 15-16. There will be more like 10-12%. And if by chance, see, a lot of global events are happening. So tomorrow Ukraine stops, and a lot of commodity-related prices, energy prices, particularly energy prices, they come down. It's already coming down.
Yes.
But if they slump, then India's story looks awesome.
Right. That's some conviction. Also ahead of budget, because it comes in the face of a lot of events, right? There is a fear of global recession, there's a fear of slowing economy, rate hikes. You put all together, and in between of that we have budget. What are your expectations, and where do you think government will put its thrust in right now?
See, I don't know what all budgetary proposals will be, because her hands are also tied. There's not much, because indirect tax has gone to GST, and direct taxes where she can play with the rates here and there.
Right.
So some proposals can come there. Otherwise, GST, they keep tinkering through the year.
Right.
So I don't expect much out there. Indirect taxes, I think it will be not much of a, some proposals will be there, but I don't think it will be significant for the place, because they want to stabilize the economy, they want to grow the economy.
Right.
So what will be the growth boosters they will give, only time will tell. But I'm not expecting anything from the budget in terms of any major changes in any aspect. There's some tinkering here and there, yes, but not, because they want to have the growth continuing.
Right.
The government's intention is clearly to see that 7-8% growth comes.
Right.
We grow at 7-8%. So what they will do, maybe they can allocate the infra spend a lot more, because they can cut on subsidy now. Now the economy is broadly out of COVID stress. Broadly, I would say. So you can cut at least 60-70% of the COVID spend by way of subsidy, food and all in 23-24, and put that money into the infra.
Fair enough. And also, Mr. Agrawal, a lot has been spoken about the LTCG, right? Everybody has been spoken. There is a compelling case.
Every budget
we talk about it, and every budget we get disappointed because nothing comes on board. What do you think? This time around, it's going to be any different? Any tinkering
I don't know
coming
what
around?
they'll do, but they should not do anything. That much I can tell you. On the shares and all, because people have sold things based on instability of rates and what is long term, what is short term and all. Now, if you keep playing with the duration or rates, I think it vitiates the investment environment. If I have present in my calculation 1 year long term capital gains, and say 10% plus a charge as a tax rate on the long term. Now you say that it is going to be less than 2 years, or 3 years is going to be your long term, short term. Then that my tax rate goes from 10 to 15. So that vitiates the thing, They should do it only if it is necessary, because they understand what they are doing. But cosmetic changes should not be they should not be touching LTCG broadly, but fine tuning here and there is okay.
Sure. So you're not expecting any rationalization of taxes because you feel the more consistent we are, the better we are in terms of the investment. And you might just, LTCG is something that you feel that they might just tinker around, but you're not expecting much out of it.
I mean, I don't have any information, but my sense is that there's no strong, I mean, there is a presentation by some association or something that every asset class should be treated same.
Right.
So better they should come down rather than take it up.
Come down rather than take it up.
If it is for real estate is 3 years, they should make it 1 year rather than making the stocks 3 years.
Okay, fair enough. Also, you think this budget is now a golden opportunity to streamline? Maybe the old tax regime could be disincentivized a little bit, and the new tax regime can be more favored on the personal taxes level. Do you think any of that would be favorable?
See, I don't know whether, but I think government is practicing a lot of supply side economics. They want to clear up all the shortages so that there is no shortage-led inflation. But I think that is good broadly, infrastructure and all those kind of stuff. But there are some segments of the economy which are very badly hit by the COVID and low income, and inflation more on top of it silently. I think there they need to give some relief by way of lower taxes for the goods consumed by them, or
right.
something, because the consumption build up, demand side, my sense is very necessary, and that can be done only effectively through direct taxes or even indirect taxes on the cheaper goods or very mass consumption items. Instead of 18%, if you tax them for 3-4 years at say 10% or something like that, that can do a little bit of magic.
Let's actually move on to a lighter segment, which is a rapid fire round.
Yeah.
I have 10 questions for you. We have 15 seconds. Whatever is at the top of your mind, you just shoot.
Yeah.
Okay. Talk about the asset allocation, equity, gold or real estate. What will be the better option?
People who are looking to build equity portfolio which had come down below 5, I think that opportunity is there, but I would go all the way into equities.
Right. Okay. One thing that you probably got wrong in 2022.
22, we got wrong on the digital companies, We
Right.
became really optimistic on that.
The new
We got
age
it completely on new age companies. Now we paid good price for that. So, yes, you get something wrong at some point of time. And but we remain bullish on the market, so our overall allocation always remained 100%. So that helped somewhat.
So talk about the valuation of these new age companies, talk about Nykaa's Matro and probably something like Mama IPO valuations. Do you actually think they're a little on the expensive side?
Less said better, because they've already corrected by 50, 60%, 70%. So how much more to go, They're definitely not cheap, I can tell you this, even today. For what we know of, but because they're still making losses. They're still not coming profit. So
That's true. That's true.
So when they're under stress in terms of valuation, anything can be right price. In the sense that right now you're still looking at significantly high P multiple or high valuation multiples like price to sales, price to book, price to earnings. Earnings तो है नहीं तो क्या करोगे? So so earnings not being there and the interest rates are rising, I think it becomes tough for these companies to justify valuation.
Your inspirational quote that you keep in mind while managing investor wealth?
Now, don't lose money. What Buffett keeps saying, don't lose money. Buy at some price. Buy what you understand. Second, buy at reasonable price so that even if it is wrong, it doesn't hurt you that deeply.
Right.
And we'll keep making money. We'll keep making money. But trying to make too much money too quickly, that destroys the portfolio.
I agree to that. Your favorite book?
I think I read last year Howard Marks' book, Mastering the Cycle. That seems to be a good book,
Fair enough. 3 stocks that were your notable investment and shall continue to be.
So I don't buy stocks directly.
Sure.
It is all in the. We hold a lot of mutual funds. We
Sure.
are the largest investor in our own mutual funds.
Sure.
So it's all held through the mutual fund companies or the schemes. So I don't have a direct recommendation for any stocks.
Okay, so just a little bit on the Twitter CEO, Elon Musk, your view on that. He's better off managing
Quite a
Twitter.
guy. I mean, the headline was about $200 billion losing, but the guy who can make 300, 400 billion, he only can afford to lose 200 billion.
That's true.
You know, so first we should give credit to him that he did make 400 billion, and of that, half of it is gone. So, yeah, I mean, he's quite a guy. He's fearless. He's fearless, and he's still young, 50 years of age.
Yeah.
So a lot to go, and a lot of there in his head about the innovation of internet and how to exploit into space and things like that. So interesting guy, very expensive still, I would say. There's still more to correct in Tesla stocks.
Well, some corrections out there, I would say. Also, which according to you is a bigger corporate governance nightmare, Paytm's buyback or Nykaa's bonus issue for 2022?
Keep me out of this.
Anything that you want to speak about, maybe pick one event and not ask about, not describe it any further.
No, but buyback for a loss-making company, I don't understand. And that will be the IPO money. If you have your own reserve money, then it is one thing. But with IPO money to buy back, there must be a very good reason for doing that.
Some heart out there. And the last question, before I let you go, your stress buster. One thing that you like the most and which keeps you off your stress.
The stress buster is that don't bother too much about the market fundamentally. Because I'm unleveraged, and I go extra mile to see that I'm not leveraged. So in markets, if you're not leveraged, you can lose only your money.
Right.
And you cannot lose more than say 5,000 crores. I can lose maybe 20%, 30%, 40%, 50%, what more. But what is left is also a lot for me. So that frame of mind should be there that, boss, God has more than well taken care of you.
Right.
So be stress free. And then you run for as much as you can run.
Okay, I'm going to squeeze one more. If not for the chairman of MOSL, what's your alternative career choice?
And I would have been a stock picker all the way. Whether as a chairman of Motilal Oswal, as an individual investor, or some flunky somewhere, but I would have been a stock picker.
Okay, I think we're going to leave it at that. Thank you so much.